Hey, in this video, we're going to take an in-depth look at the very popular triple EMA scalping method. It's been reviewed by quite a number of channels, and I'm going to take my own whack at it. I'm going to talk a little bit about how to set up the indicators, the entries and the exits involved in the strategy. Then we're going to run a 100 sample back test to answer the question if the triple EMA scalping strategy is effective. And hopefully along the way, you can learn something about the markets to help you become a better trader and investor. So let's hop right into the settings. To do this, you're going to need 3 EMAs. Very simple technical setup. The first one at a length of 20, the second one at a length of 50, and the third one at a length of 200. I colored the fast one green, the middle one 50 white, and the slow 200 red. So the idea behind the strategy, for long entry, if price is trading above the 50 and the 200 moving average, wait for a pullback to the 20 moving average, and then enter. The goal of the trade is to get to that last high, and the stop that is most commonly used is 1.5 to 1 risk to reward ratio. So that's what a long trade will look like. It comes back, pulls back to the here, you enter, and it breaks the high to continue trend, and you exit the trade. It's a quick scalp, and you wait for it to pull back, and you buy it there, set up to the last high or so, and you're looking for 1.5. And it just about stopped out there, but it did eventually end up getting your trade. If you were stomped out, you just wait for it to come back, do another reciprocation, and you try it again. But the idea on this is that your winners are larger than your losses, and you'll win a little bit more than you lose. And the same thing on the short side. You wait for it to pull back to the line, you take it to the last low, and then you're looking for a 1 risk to reward. And there's your scalp. So with all that being said, I'm going to go ahead and start the back test. Hey guys, so I'm back with the back test, and well, the results were surprising. It didn't perform as well as some people might have suggested it might. It still made some money, but really not a lot. You can see we had $5,000. We took 100 trades. We won 46 of them, and we lost 54 of them, for a 46% win-to-loss ratio. That might go up and down, but I have a suspicion that it's gonna hover right around 50%. We had a total P&L of $46, or an average trade of 47 cents. This was taking 10 SPY shares at a time. We had an average win of $6.60 and an average loss of $4.75 for a risk to reward ratio of 1.389. It would be closer to 1.5, and I'm sure it'd probably be just about exactly 1.5 at a 50% win-to-loss ratio. So what happened here? That's a good question. And I can answer that because I know my way around some math. You can see a lot of your winners, what happened was you won the trades in which the pullback from the high was not that large. That was your most common winning trade, was when it was a small pullback and it had a really short profit target. It also had a very small stop. You won a lot of them, but some of the markets in which there was a bigger pullback and you had a larger profit and loss target, you often lost though. You did have a couple of big winners in there, as you can see, but a lot of the bigger trades that got executed were on the losing side as far as distance from entry. So that's kind of the overall results. Anyways, I hope you enjoyed that. I hope you learned something about the marketplace, and take a chance to look at my other content if you found this interesting. All right, you have a great night.